The Bollinger Bands indicator is a popular tool in technical analysis, developed by John Bollinger. It is used to measure market volatility and identify potential overbought or oversold conditions. Here's a detailed explanation of how it works and how it can be used in trading. The Bollinger Bands consist of 3 lines. The middle band is a simple moving average of the price, typically set to 20 periods. The upper band is the middle band plus 2 standard deviations of the price, and the lower band is the middle band minus 2 standard deviations of the price. Bollinger Bands expand and contract based on market volatility. When the bands widen, it indicates increased volatility. When they narrow, it indicates decreased volatility. When the price is near the upper band, it suggests the security might be overbought and could be due for a pullback. When the price is near the lower band, it suggests the security might be oversold and could be due for a bounce. If the price repeatedly touches the upper band, it may indicate a strong uptrend. Conversely, if the price repeatedly touches the lower band, it may indicate a strong downtrend. A move outside the bands can indicate a potential trend reversal or continuation, depending on the context. Bollinger Bands can help identify patterns such as M-tops and W-bottoms, which can signal potential trend reversals. A breakout above or below the bands can signal the start of a new trend. However, it is essential to confirm the breakout with other indicators or analysis. Imagine you're analyzing a stock that has been trading within a range. If the price touches the upper band, it might be overbought, and you could consider selling or shorting. Conversely, if the price touches the lower band, it might be oversold, and you could consider buying. Additionally, if the bands start to narrow, it suggests that volatility is decreasing and a significant price move could be imminent.